Sunday evening, precisely at 6 p.m. Eastern, the futures markets ignite in Asia, and a new chapter in financial history is set in motion. In an instant, $688 billion vanishes. The liquidity that has propped up U.S. markets for 2 decades is suddenly gone. Right now, your retirement savings are left completely vulnerable. Automated trading systems are already set, sell orders are lined up, and by the time you check your accounts on Monday morning, your investments could be wiped out. This isn't a guess, it's a matter of numbers. The leading stocks that have driven the bull market are about to be taken down. The safety nets are riddled with gaps, and those with inside knowledge aren't sounding the alarm. The countdown is underway, and most investors remain oblivious to what's about to unfold. Welcome to Currency AG, where we treat you as the savvy, experienced investor you are. Here, we know you can distinguish between empty chatter and meaningful data, between hype and hard facts. We don't waste your time. If you appreciate analysis that respects your intelligence, the kind of insight you'd expect in a boardroom, not a sideshow, then you're in the right place. Let us know where you're tuning in from. New York, London, Singapore, Mumbai. Share your location in the comments, because when Sunday night arrives, we want to see who was alert and who was ready. Let's get to the heart of the matter. Time is running out, and most people have no clue that the financial landscape is about to be transformed forever. As families enjoy their Sunday evenings, as the world relaxes, the most perilous financial event in recent memory is about to erupt. At 6:00 p.m. Eastern, the Asian futures markets will open, and the calm will be shattered. This event has been dubbed Black Sunday, and the name is fitting. What happens in those first moments will decide the fate of trillions in global wealth. The catalyst is straightforward. China has offloaded $688 billion in U.S. Treasury bonds. For those not closely following the markets, that figure might seem abstract, but the consequences are severe. For 20 years, Chinese investment has been the unseen force supporting American asset prices, the ever-present buyer, the steady hand, the bedrock of the system. Now, that support is gone, and when the foundation disappears, the structure doesn't hover, it collapses. Many retail investors assume the market is dormant over the weekend, that their portfolios are safe and untouched until Monday's opening bell. This is a dangerous misconception. The market never truly sleeps. While Americans rest, capital is shifting in the shadowy trading pools of Tokyo, on the bustling floors of London, and through algorithmic networks worldwide. The market is always active, always calculating, always ready to move. Sunday night brings a risk that few understand, the risk of a gap down. This means the market could open far below where it closed on Friday, not a slow decline, but a sudden, sharp plunge. 10% of value could disappear in seconds, with no chance to react, sell, or protect what took years to build. Investors will wake up Monday to find their portfolios decimated. The algorithms that dominate today's markets are programmed with a single directive: sell first, ask questions later. When volatility spikes and liquidity dries up, these machines act instantly and without emotion. When the Asian markets open, the selling will be swift and merciless. China's exit from the US dollar system has created what experts call a liquidity vacuum. Liquidity is the lifeblood of markets. Without it, prices suffocate. Crashes don't happen because everyone sells at once. They happen because there are no buyers. When the market looks for buyers on Sunday night, it may find none. Prices will keep dropping until anyone is willing to step in. That point could be 30% below Friday's close. For those with retirement accounts in stocks or bonds this weekend, the risk is existential. Years of gains could vanish in minutes. Pension funds across the nation are already on shaky ground, barely solvent and relying on stable markets. A 20% drop would force them to liquidate assets at fire sale prices, pushing prices even lower and triggering a downward spiral. Millions of retirees are sitting on a fault line, and the quake is set for tomorrow night. Typically, when markets face catastrophic drops, there's a safety net, the so-called plunge protection team, an informal group of government and financial leaders who step in to buy stocks and provide liquidity. But this time, the situation is different. The government can't print money fast enough to counter the selling from China, the BRICS nations, and sovereign wealth funds moving out of dollar assets. The money printer that saved markets in 2008, 2020, and every crisis of the past 15 years is now ineffective. With inflation still high and the dollar's reserve status in jeopardy, printing more money would only undermine the currency. The plunge protection team will try, but the tidal wave from the east is too massive. They'll be overwhelmed, and when the safety net fails, the fall will continue. As stocks crash, portfolios evaporate, and panic spreads, one asset is poised to surge: silver. The capital fleeing the collapsing stock market needs a refuge, and it's heading for the last safe haven. The money isn't disappearing, it's moving from paper to metal. Those holding silver on Sunday night may hold the winning ticket. The stock market crash is just the start. Modern finance is like a house of cards. Disturb one, and the whole structure shakes. Remove one, and everything collapses. The destruction in stocks on Sunday night will trigger something even more dangerous, a crisis that jumps from Wall Street to Main Street in hours. When people see their retirement savings wiped out, psychology takes over, and psychology is the most powerful force in finance. Before dawn on Monday, before the first coffee is poured, Americans will rush to their banks, not to deposit, but to withdraw every dollar they can. This is how bank runs start, not with careful planning, but with raw fear. The problem is, the banks don't have the cash. The modern banking system operates on fractional reserves, meaning only a small portion of deposits is kept as cash. The rest is loaned out or invested in assets that can't be quickly sold. When crowds show up at ATMs on Monday, the machines will run out, withdrawal limits will be imposed, and banking holidays will begin. The financial and banking crises are two sides of the same coin. When one falls, the other follows, as history has shown time and again. The crash of 1929 began on a Monday. So did the crash of 1987. Why Mondays? Because bad news builds up over the weekend, intensifies in the dark, and by Sunday night, fear reaches a breaking point. By Monday morning, panic is unstoppable. But there's one market that doesn't wait for Monday. Cryptocurrency, Bitcoin, Ethereum, and the entire digital asset space trades around the clock. This means crypto will be the first domino to fall. On Sunday afternoon, before stock futures even open, crypto markets will experience a violent, sudden collapse. Not because crypto is worthless, but because traders need cash immediately. Large investors, hedge funds, and institutions hold positions across stocks, bonds, crypto, and commodities, all interconnected and leveraged. When stocks crash Sunday night, brokers will issue margin calls demanding immediate payment. The only assets that can be sold instantly at any hour are cryptocurrencies. So desperate traders will dump Bitcoin and altcoins to raise cash for their margin calls. The selling will be fierce and indiscriminate. Bitcoin could plunge 30, 40, even 50% in hours. But unlike stocks, crypto is likely to recover because it isn't tied to any government or central bank. Once the panic selling ends, people will realize that digital assets offer an escape from the collapsing dollar system. But that realization comes later. First comes the fear, and it will be intense. Now, let's turn to the bond market, where the real devastation is unfolding. Most investors ignore bonds. They seem dull and technical compared to stocks or crypto, but bonds are the backbone of everything. When China sells $688 billion in U.S. treasuries, the supply surges. When supply rises without matching demand, prices fall and yields climb. This isn't theory. It's mechanical, mathematical, and unavoidable. The 10-year treasury yield is nearing 5%, a level not seen in over a decade. This matters because stock prices are based on models that compare earnings to bond yields. When yields rise, the fair value of stocks drops automatically and systematically. If the 10-year yield breaks above 5%, the fair value of the S&P 500 could drop by 30%. Not gradually, but instantly. The bond market is crushing the stock market, and no one in mainstream media is warning the public. Why? Because they need retail investors to stay in, to be the last buyers, to absorb the losses. If the truth were told, everyone would sell on Friday, and the crash would happen immediately. So the silence is strategic, keeping the exits clear for the elite while trapping ordinary investors inside. The wealthy are already prepared. Short positions are set, put options bought, capital moved to safety. They're not just protecting themselves. They're positioned to profit from the crash. This isn't a conspiracy. It's how wealth transfers occur in every major crisis. The informed take from the uninformed, the prepared from the unprepared. On Black Sunday, the largest wealth transfer in modern times will begin. Stock exchange circuit breakers are meant to provide safety. Automatic halts at 5%, 7%, and 10% drops. But these pauses don't stop crashes. They only delay them, sometimes making things worse. When trading halts, fear grows, and when the market reopens, selling often resumes with even more force. A halt on Sunday night won't signal safety. It will show the system is broken. And when the system breaks, the rules change. There's a secret about the stock market that Wall Street keeps hidden. The entire system, trillions in value, rests on just 7 companies: NVIDIA, Apple, Microsoft, Amazon, Google, Meta, and Tesla. These tech giants have carried the market for years, creating the illusion of invincibility. But on Black Sunday, these leaders will fall. These 7 companies make up nearly 30% of the S&P 500's value. When liquidity dries up and Chinese capital exits, these overvalued tech stocks become the main targets. Not because they're bad businesses, but because they're the most expensive and vulnerable. A 20% drop in big tech overnight isn't just possible, it's likely. When the leaders fall, there's nowhere left to hide. But the concentration issue is just the start. There's a more dangerous threat lurking: leverage. Record amounts of stock have been bought with borrowed money, margin debt at levels not seen since the dot-com bubble. Investors have borrowed to buy more shares, convinced that stocks only go up and leverage is safe. This belief is about to be shattered. When prices drop, even slightly, Brokers issue margin calls, demands for immediate cash. If investors can't pay, brokers sell their stocks automatically at any price. This forced selling drives prices lower, triggering more margin calls, more forced selling, and a downward spiral. On Sunday night, millions of leveraged traders will get the call that wipes them out, the call they never thought would come. The leverage that inflated the bubble will be the force that bursts it. And once it starts, there's no stopping it. The contagion doesn't end with stocks. It spreads everywhere. Real estate is next. When people see their net worth evaporate, they no longer feel wealthy, and people who don't feel wealthy don't buy homes. This is the wealth effect, and it works both ways. Rising portfolios encourage spending and investment. Falling ones cause panic and cancellations. Pending home sales will be scrapped, luxury real estate will freeze, and open houses will be deserted. The already fragile housing market will be pushed over the edge. Black Sunday will trigger the housing crash that's been looming for months. The stock and real estate crashes will merge into one disaster. Now, let's discuss something most investors overlook: corporate buybacks. For the past decade, corporations have been the biggest buyers of their own stock, using cheap borrowed money to repurchase shares, inflate prices, and boost executive pay. But interest rates aren't low anymore. The economy isn't growing, and cheap money is gone. Without buybacks, the market loses its artificial support. Now, the true value of these companies will be revealed, much lower than current prices. The adjustment will be painful. There's another mechanism at play: the VIX, or Volatility Index, the market's fear gauge. For years, the VIX has been kept artificially low through derivatives and options trading. A low VIX signals calm and confidence, but on Sunday night, the VIX will skyrocket, 50, 60, even 70, signaling absolute panic. When the VIX spikes, risk parity funds, huge algorithmic systems managing hundreds of billions, are forced to sell stocks, not by choice, but by programming. This mechanical selling adds billions in pressure to an already panicked market. The machines will crash the market faster than any human could. No emotion, no hesitation, just relentless execution. There's one more wild card: geopolitics. The Middle East is on a knife's edge, with Iran threatening vital oil routes and shipping lanes under constant risk. One wrong move, one missile, and energy prices could soar. China is circling Taiwan, military drills intensifying, rhetoric escalating. Even the threat of conflict can send risk assets into freefall. Any major geopolitical event over the weekend will amplify the crash. The markets are already fragile. Bad news from conflict zones will pour fuel on the fire. For an entire generation of investors, this will be their first real crash. Anyone who started after 2008 has only known rising markets. Buy the dip, hold forever, trust the system. This crash will shatter that faith. Investors will realize, perhaps for the first time, that the stock market isn't a wealth generator. It is a mechanism for transferring money from the uninformed to the informed, from the unprepared to the prepared, from the emotional to the calculated. This loss of trust will create a generational scar, and those burned may never return. They'll pull their money, move to cash, and stay away from equities. The result could be a long-term bear market lasting years, even decades, because once trust is lost, it's slow to return. All the amplification mechanisms are in place: concentration, leverage, forced selling, the end of buybacks, algorithmic triggers, geopolitical risk, psychological trauma. Each one feeds the next, making the crash worse. This isn't just a correction, it's a systematic dismantling of everything built over the past 15 years. And it all starts Sunday night at 6 p.m. Eastern, when the Asian futures open and the chain reaction begins. Black Sunday isn't just about one night of chaos, it's about what follows. The world on Monday morning will be fundamentally different from the one that existed on Friday. Markets will be shattered, confidence destroyed, illusions gone. But the real damage isn't measured in numbers, it's measured in decades. What happened Sunday night will echo through the financial system for a generation. Think of the young investor, 25 years old, just starting a 401k, never having experienced a true crash. Sunday night will be their harsh lesson, immediate, unforgettable. The fear, the helplessness, the sense of betrayal will shape their approach to investing for life. And this psychological blow creates what economists call a generational bear market, a deep, lasting shift in how an entire generation views risk and wealth. These investors will pull out, move to cash or bonds, and may never return. The market relies on new money, new participants, new believers. When a whole generation steps back, the market withers, prices stagnate, and the myth of endless growth dies. This is the long-term consequence few are considering. Now, let's talk about pensions, where the math becomes truly grim. Pension funds across the U.S. are already stretched thin, needing 7% annual returns just to meet their promises. A 20% crash on Sunday night puts them years behind, and the math to recover is brutal. A 20% loss requires a 25% gain just to break even, and in a broken market, that's nearly impossible. The result? Pension benefits get slashed, retirement ages rise, monthly payments shrink, and cost of living adjustments vanish. Black Sunday doesn't just erase wealth today, it robs future retirees of security. People who worked for decades, who trusted the system, will find in their later years that the money isn't there. The social fallout is unimaginable. Yet, while institutions crumble and investors panic, something remarkable happens in the precious metals market. Every major financial crisis has a winner, an asset that not only survives but thrives. In the 1970s, it was gold. In 2008, gold again. In 2026, it will be silver. Silver is currently the most undervalued asset, trading at a fraction of its historical ratio to gold, ignored by big investors, overlooked by the mainstream, quietly waiting for its moment. Black Sunday is that moment. When trillions flee the stock market, when safety is desperately sought, when the dollar itself is in question, even a small portion of that capital moving into silver will send prices soaring. The silver market is tiny compared to stocks or bonds. It doesn't take much to move it dramatically. A massive green spike pushing silver past $100 an ounce in minutes isn't just possible, it's likely. This is the safe haven rotation, the moment when frightened capital abandons paper assets for hard ones. Gold will rise, but silver will skyrocket. Because silver has something gold doesn't, industrial demand. It's used in electronics, solar panels, electric vehicles, and medical devices. It's both a monetary metal and an industrial commodity, giving it leverage gold lacks. As the world rebuilds after the crash, as infrastructure and green energy projects ramp up, silver demand will surge while supply remains tight, sending prices even higher. But there's another unprecedented development. The dollar itself is under siege. Normally during a crash, investors flock to the dollar as a safe haven. But this time, the crash is being driven by the dollar losing its reserve status. China is dumping treasuries, BRICS nations are moving away from dollar trade, and central banks are diversifying. The dollar is now the problem, not the solution. So capital will flee not just stocks, but dollars too. Where will it go? Gold, Swiss francs, Bitcoin, and especially silver. This creates a nightmare scenario, the stock market and the dollar crashing together. Stagflation, rising prices and falling asset values, the worst of both worlds. For those holding precious metals, this is a transformative moment. While others panic and lose everything, silver holders see their wealth multiply, not by luck, but by understanding the math. They know that liquidity is the foundation of all asset prices, and when it vanishes, only tangible assets endure. The time to act is now, not Monday, not next week, not after the crash starts. The window for preparation is measured in hours. Those still in stocks should consider hedging. Put options, or inverse ETFs, moving to cash, anything to reduce exposure before Sunday night. Those already in cash should move to physical precious metals, silver coins, gold bars, assets outside the banking system. Not ETFs, not paper promises, but real metal held securely. When the system breaks, when banks close, when markets freeze, only physical assets matter. The goal this weekend isn't profit, it's survival. When Monday arrives, the financial world will be unrecognizable. Companies will have lost billions overnight. Banks will be on the brink. Headlines will scream crisis and disaster. Those who prepared, who moved to safety, who held metal, will be thankful, not celebrating because so many will be suffering, but grateful they saw the warning signs, understood the math, and acted in time. Black Sunday isn't the end of the world. It's the end of an illusion. The illusion that markets always rise, that the Federal Reserve can fix anything, that the dollar will always be king. On Sunday night, math will triumph over wishful thinking. Reality will return. And those who respected reality, who prepared, who positioned themselves wisely, will come through the chaos not just intact, but stronger. Markets can't function without liquidity, and China just shut off the supply. This isn't a prediction, it's arithmetic. The countdown is underway. The evidence is everywhere for those willing to look. The bubble has met its needle, and the needle is already pressing in. Sunday night, 6:00 p.m. Eastern, history will be made. The only question left is, will you be ready? Get your finances in order, move to safety, and keep an eye on silver. Because as the world burns, silver will shine.